Good afternoon, everybody. Uneducated Economist here. I was reading a pretty interesting article talking about the mortgage servicers out there and what's been taking place here since the forbearance has really kicked in. I mean, we're talking almost $1 trillion worth of missed mortgage payments that have happened, and the mortgage servicers, they're still liable for making the payments to the mortgage-backed security investor. So the whole mortgage market is a very interesting one. The people who have initiated the lending, the mortgage lenders out there, they're not the ones who are servicing the mortgage to the mortgage-backed security investor. What they do is they get you to sign the bottom line on that contract. They bundle it up with a bunch of other mortgages and they sell it off to a mortgage-backed security investor. Now, there's another middleman in there, the mortgage servicer. And they're the ones who collect all the mortgages and then distribute them out to the mortgage-backed security investor. And they take a little cut for themselves. So these mortgage servicers, they're still liable to continue to make the payments to the mortgage-backed security investor. Now what's going on here is that these guys, they have to pull that from either a credit line or their own cash or however it is that they do it. They are still liable to be making these payments. And the government is basically saying, hey, we're going to, guarantee all these mortgages and stuff like that, make these mortgage servicers whole. But what they are not promising is to pay the property taxes and insurance. So these mortgage servicers are still liable for that. And this is going to create a situation for the municipalities because they're kind of, relying on these property taxes to get paid. And the mortgage servicer, they're not going to get reimbursed from the government for that. They're just going to get reimbursed for the mortgage-backed security when it comes to the mortgage itself. Now, a lot of people, when they set up their mortgages, they set it up in a way that they make the mortgage payment, the insurance payment, and the property payment all in one bill. And when they went into forbearance, they just quit paying everything altogether. So these mortgage servicers, when it comes time to, when the forbearance ends, what's going to happen with those property taxes and insurance payments that they've made? Well, that's going to have to get rolled into that mortgage again and refinanced, and people are going to be making principal and interest payments on the taxes and insurance that they've missed. At least that's the way I'm kind of seeing it. And there's so many different working parts to this whole mortgage system that we have going on here in the country. Because a lot of people don't quite get it. They just say, well, the bank has plenty of money or the bank or whatever. But it's not really the bank. When it comes to, banks do make mortgages. They do write mortgages out there for people. But it's the mortgage lenders out there, which is a kind of like a private company. It's like its own business. They are not the ones who are collecting the mortgages. So when like a mortgage lender writes up a contract for you to borrow money to buy a house, they write up that contract and bundle it up with a bunch of other contracts with a bunch of other mortgages and sell it off to a mortgage-backed security investor. The mortgage servicer is kind of like the middleman in between. But these mortgage lenders, they're in a pretty tough situation right now because they don't want to be writing up a mortgage and have you immediately basically go delinquent on it if you lose your job or something like that. So they're demanding higher credit and a bigger down payment. And the banks are especially doing it. They're requiring up to like a 700 credit score now with a 20% down payment. And this is being, when they do this is creating a very difficult situation for selling homes. So even though you see the interest rates dropping, the availability for people to get a mortgage is getting harder, which is causing the pricing over in the housing market to drop. At the same time, you're seeing an inventory being depleted because people are pulling their houses off the market because they don't want a bunch of people who are, infected with COVID going walking through their house. So inventory is dropping, which would typically be a sign for prices to go up, supply and demand, less houses out there, the prices go up. But when you have it in a situation where it's more difficult to get a mortgage, the prices of the houses have to come down to meet the capabilities of the borrowers that are out there. You see what's all happening here? And then on top of it, the Federal Reserve has said, hey, these mortgage-backed securities, if you think that, there's going to be a problem with it and you're going to start dumping those mortgages, those mortgage-backed securities, we're going to be the buyer of them. So we're going to add a floor to these mortgage-backed securities to keep them from dropping in price. Because just like any bond out there, if the price goes down, the interest rates go up. And the last thing the Federal Reserve wants to see is interest rates go up, making it more difficult for the real estate market. So they want to keep interest rates down so that people can be able to get a mortgage at a lesser interest rate. But when they started buying up all these mortgage-backed securities, they created an issue with those mortgage lenders. Because the mortgage lenders, they're not really like sitting on a ton of cash. They borrow the money themselves. And what they are anticipating on doing is packaging it up with a bunch of other mortgages and selling it off as a mortgage-backed security. But before they can package it up, the interest rates could change. So what they do is they hedge that bet. So if they sign a mortgage to you at a particular interest rates, and then interest rates start to go up, just like anything, if interest rates rise, the bonds fall in price, right? Those mortgage-backed securities fall. But if they drop, then the mortgage-backed security price goes up. So if they drop, the mortgage lender actually makes out pretty good because he signed a mortgage at a higher interest rate. But the problem comes in is that they've hedged their bet. And that bet has its own investment to it, so to speak. And this is where it gets kind of confusing, because that hedge that they have purchased, that insurance policy, so to speak, will make them whole if the interest rates rise. So this is kind of the situation. They sign, let's just make up some numbers here. Say they sign a mortgage at 4% interest. They got a bunch of them in this mortgage-backed security. The interest rates drop. Well, their mortgage-backed security just went up in price that they can sell to the mortgage-backed security investors, because the investors are looking at it saying, hey, that's a mortgage-backed security that pays 4%. So they're able to buy it for a higher price because the return on it is bigger. But if the interest rates rise and they have signed these mortgages at 4%, now the mortgage lender is going to be out money because they have to sell it for a lesser price, because now the mortgages that are selling out there sell it at a higher interest rate. So just like I said, interest rates rise, bonds fall. Same thing. So these insurance policies that they have purchased to hedge against that interest rate change, that's its own investment. And they buy it on margin, meaning that they're pretty much borrowing the money to do it. And they use that instrument, that hedge itself, as the collateral to buy it on margin. So it's like its own investment, completely separated from the rest of it. And when the interest rates drop, that investment falls. And if it falls, the brokers who sold it do a margin call, which is forcing those mortgage lenders to come up with a bunch of money. So when the Federal Reserve steps in and starts buying a bunch of mortgage-backed securities, it screws those mortgage lenders on that hedge that they have made. Even though the price that they can sell the mortgage-backed security for that they have built can go up, that separated investment, that insurance policy that they have purchased, falls, and it really screws them. And there was a few of them that got screwed really hard when the Federal Reserve was buying up a bunch of them a while back. So the mortgage lenders are sitting in a pretty difficult situation. So they're wanting, basically more down, or I don't know necessarily they want more down, but they want to make sure that the product that they are selling to the mortgage-backed security investor is a sound investment. So it's more difficult to get a loan from these guys because they're being a little more stringent on who it is that they are lending money to. And not even lending money to, but writing mortgages for. Because they really don't lend money out to anything. They write the mortgage up and then sell the mortgage off, and that's where the money really comes from. The mortgage servicer, on the other hand, is sitting on a bunch of forbearance situations where they are continuing to make payments, even though it's backed by the government. They're not necessarily getting reimbursed for the property taxes and insurance that they have to cover from people who are not making those payments. And then the mortgage-backed security investor out there, think about this, is that unless they are anticipating selling it to the Federal Reserve, there's a lot of these guys out there who I'm sure are looking at it going like, yeah, with all these people who are being unemployed and stuff like that, the chances of them being able to be made whole on their mortgage-backed security, that situation is starting to come into question. There's a lot of moving parts to this stuff. But what does it all mean for the housing market? Well, with all this question going on out there, even though you have the interest rates dropping, I see the prices coming down as well. Even though the inventory is dropping, I see the prices coming down to meet the capabilities of the borrowers who are out there, who need to have at least a 700 credit score and a 20% down payment. Anyway, found that to be a pretty interesting article talking about the taxes and insurance, and I'll leave that down in the description for you guys. Uneducated Economist. You guys let me know.